welcome. In a recent interview with the Times of India, the incoming head of Mercedes India operations, Santosh Iyer, said that investor awareness around systematic investment plans in mutual funds is driving disposable income towards SIPs and it's eating into luxury car sales in India. Now, we let the experts and the economists decode and debate that, but for our purposes, it's indicative of the popularity of mutual funds as an investment vehicle, as a method for many Indians in generating long-term wealth. And there is some data to back this. Investment in mutual funds through SIPs hit an all-time high of over 13,000 crore rupees in October this year. As per the Association of Mutual Funds in India, there are roughly 14 crore mutual fund accounts, 11 crore of which are retail accounts. And mutual funds in India manage about 40 lakh crore rupees of investor wealth. While many of us invest in mutual funds, how many of us actually know how to allocate the assets? How can you build a portfolio in the long run? And what are the strategies that you can deploy? Now, today I have with me someone who has thought very deeply about these questions, formulated strategies, and has been managing investor wealth for decades. I'm very happy to welcome Ajit Dayal, founder of Quantum Advisors Private Limited and Quantum Mutual Fund. Ajit set up Quantum in 1990 as an independent equity research house. He advised global investment firms on India investment strategies. He founded Quantum Mutual Fund in 2006 with a philosophy that focused on the investor. Today, it manages around 2,000 crore rupees of investor assets. The financial services group, Quantum Advisors Private Limited, manages around 2,000 crore rupees of international investor wealth. Ajit Dayal, welcome.
Thank you for having me, Melanie. Really appreciate that. Thank you.
And we're very happy to have you here with us. Ajit, to begin, you founded QMF in 2006, with a set of rules which spoke of transparency and integrity in managing other people's wealth. You were also the first direct to investor fund in India. You've seen the segment grow, you've seen it evolve. What are the things that give you hope and what are the challenges that you see ahead?
So one of the big challenges of managing money locally in the domestic market is that you need to have brand name and brand presence. So you see the names of big banks or big, multinational organizations that have got joint ventures in India, few and far between, and of course of the local industrial families and groups. So that gives people comfort in that sense. Although, of course, mutual funds, as you know, are like a wrapper. No fund management company really owns your money. We're really a pass-through, and you own the assets, you own the shares through the trust structures that have been created, and there are independent trustees, and there's depositories and banks that have all the money and the assets. So there's never a risk per se of giving any money to an AMC, no matter how small, and there's no advantage of giving an AMC money, no matter how large it is. But, and I'll tell you, there's one number which will depict our large challenge in India, which is that internationally, we actually manage or advise over 20,000 crores of international money into India. And within India, which is our home base, we manage only 2,000 crores, 1/10 of that. So clearly our challenge is how do you make the 2,000 crores into 20,000 crores and hopefully one point in time, 2 lakh crores in the future. And that's what we're working towards. But it doesn't take away from our desire and objective to ensure that we will not grow for the sake of gaining market share. We will grow only if we are relevant to the customer in terms of integrity and also in terms of competence, that we have products and solutions that make sense and will change their lives. If not, then we deserve to die by the wayside, no matter how transparent or how integrity we may hold in terms of high esteem ourselves and how others may hold us too.
All right. But what are the kind of best practices you'd like to see incorporated by fund houses? Perhaps even made into policy.
We'll have to have a very long show for that. And I think SEBI will agree with me that there's a long show needed for that. But in 2006, when we got the license or when we launched our first fund, I went across to meet the distributors who I knew very, very well in the country. And I went with a big, PowerPoint pitch on, why they should encourage their investors to look at this new baby around the block, this new kid in the block, quantum. And, end of the day, it was shocking. I was given a sheet of paper by some, a cyclo-style sheet of paper, not even a well-printed sheet of paper, a cyclo-style sheet of paper. One column was how much AUM do I want on launch? The second column was how long do I want that AUM to stay with the fund that we're launching, which at that time was a quantum long-term value fund. And the third column was the commission that I would have to pay. So imagine you go to a Chinese restaurant, you have to circle, which number dish you want. You want 63 and you want it with prawn or chicken or with tofu. You circle that, you circle the sauce, whether you want a Szechuan or you want a satay, whatever it is. Those were the choices given to me. And I said, hang on, isn't this a bit absurd? Shouldn't you want to know more about us as a firm? So I learned this from a group called Vanguard, which is the largest fund house direct investor in the world. Vanguard taught me the 4 Ps. I used to manage money for them for about 4.5 years. And the 4 Ps that they look at when they hire an external manager to manage part of their AUM is, the first is, who are the people behind the venture? Second, what is the philosophy of those people behind the venture? Third, what is the process that they put in place to convert their philosophy into a proper stock picking, replicable portfolio? Which brings me to the fourth one. The fourth P is actually about the predictability of the performance once you've built a portfolio. Not the performance per se, but the predictability of the performance. To give an example, if I'm a value manager and I'm not buying the Paytms of the world and the Nikas of the world and the FANG stocks of the world, you know that when the world loves FANG stocks, we should be underperforming because we don't own those stocks. Similarly, when the world is in crisis and people don't like those kind of stocks and they're scared of FTT and they're scared of Bitcoin, stocks like us or portfolios that we build and the stocks we own should do better because a value manager, true to style, should buy companies that have got profits, that have got low debt, and have got high cash flow, free cash flow. So, that's what we have to see, the predictability of that performance, the 4P. So we build quantum very diligently, over our decades of experience of A, how to manage money, and B, how to ensure that we exist solely for the customer, and any profits we make, and of course we want profits, is a byproduct of those two. So if you look at the industry, to go back to your question, 2016, opaque. You looked at the annual report of any mutual fund house, no matter how big they are, no matter how grand, 4-letter or 8-letter names they may claim, in their headlines. We found that the one person whose fees were not disclosed were the marketing person or the entire marketing channel. So you disclose the fees of the fund manager, the AMC fees, the trustee fees, all of the costs were disclosed. That one hidden opaque structure was, what do you pay the distributor to actually entrap, and I'll use the word entrap, an investor into the fund house. So, when I told these when I told the distributors that this is what we're going to do, one of them, laughed at me, and I guess he was right. He said, you know what, you're never going to succeed because you are an ant in the industry. And I, as a distributor, can make the elephants dance. So I wrote an article, please do look for it. It's called The Ant and the Elephant. And I wrote that in 2006 at the launch of Quantum. And, he was right. I mean, we are struggling. We are still an ant. We're not a large elephant, but size is not what we're after. We're after what we call the thoughtful investors who understand that they are being shopped around. When you go online, as they have been saying, everyone's saying, you are the pig, you're the product that's being sold. In a very similar way, when you go to a fund house, you are being shopped around by the fund house, by distributors. Now, SEBI has come out with a lot of laws over the last decade to cleanse the system. Is it perfectly cleansed? No, there are limits on what you can pay distributors. But we are we're a very smart community, innovative community in the field of finance. And we all know Jugaad and we know stuff, and there are enough ways to probably pay distributors more than they should. So it's become a lot better. It's a lot more transparent, but I'm sure if you ask SEBI, they'll tell you there's a long way to go before AMFI and the fund industry, including ourselves, get our act together to the perfect level that SEBI would like to see it.
Ajit, that's really the moot point, because that also helps investors who are investing. And at the end of the day, as you pointed out, people, philosophy, the process to portfolio and the predictability of the performance of that portfolio, that should be driving fund houses, and especially when they go to manage investor wealth. But there's a lot of wealth which is flowing into equities, which is flowing into mutual funds ever since COVID. Now, as an investor, how should I go about choosing the right fund house? Because you're right, I'm shopping and I'm a guinea pig. So, how do I choose the one that's going to be transparent about my money to me?
Well, for most people, they really don't get to choose because they go to a bank or they go to their friendly advisor, wealth manager, and that friendly advisor, wealth manager directs them to certain funds. The other thing that I think people get caught on is performance, that last P. Everyone gets hooked on, and the media talks about this fund house had a great NAV this quarter, this month. No, investing, not speculating, investing is for the long haul. And that goes to the comment that was made about the Mercedes cars being so less. Well, if you go back in history and you look at the data of household savings, where have they been flowing? It actually was around 2014 when Prime Minister Modi was elected for the first time that you saw this surge of people coming back into mutual funds and the stock market after the rout of the Lehman crisis and the 2005, 6, 7 brick story, unwound and Lehman went bankrupt. So for about 6, 7 years, people were sort of frightened of getting back into stocks. And the sort of confidence that came in with a new regime and a new India being born and that new feeling, that brought people in. I think COVID accelerated it. But if you look at the data points, it really was 2014 that you first started seeing flows into Indian mutual funds being as large as flows by FIIs or FPIs into the Indian market. So the slight sort of thing there. But going back a bit, one is, okay, you want returns. The question is, are you looking for short-term or long-term? If you're investing in mutual funds, by default, you become a long-term investor. And enough studies have shown that 90% of returns really come from asset allocation, being in the right asset at the right time, as opposed to being in the right stock at the right time. And you can go around and you can Google and you'll find all these studies and PhDs on it, etc. And I realized that people didn't recognize that around 2008. So if I may give you a bit of an example there. So 2008, we're hit by Lehman, and I'm taking my family on a holiday to Florida, where I used to live and work many years ago. So I'm heading there to meet friends, and I used to write a column called The Honest Truth. So I wrote an article saying, I'm in Florida, enjoying myself on the beach, and the world is sort of, crumbling around me. And a few people commented and saying, look at this guy. He's out there in the US, enjoying himself in the fun, in the sand, having fun. And, we're all suffering here because our portfolios are decimated. And then it struck me that all those comic books and all those articles I'd written in the past, showing a pyramid and showing the base of the pyramid as being your safe money, and then your investment money in the middle. And then on the top is all the satta. You want to do all the stupid stuff you want to do. You want to buy Bitcoin, you want to buy crypto, you want to go to horse races, you want to buy matka, lottery, do all that, the tip of the pyramid, small amount of money that no one had really remembered or forgotten what I was writing for decades. So in The Honest Truth, at the bottom of the page, I began writing a table saying, this is what I suggest you should do, and this is what I am doing with my money. And basically that led to what we're going to hopefully talk about, 12, 20, 80 or 12, 20, 80. So I looked at my monthly expenditures and I said, if the world around me is to collapse, how many months of those expenditures should I cover without really worrying about life? So in my case, I have a fair amount of responsibilities given my family situation. So I wanted to have about 24 months. So if I'm spending 1 lakh a month, I want 24 months or 24 lakhs of rupees kept aside really safely, that I don't care what I'm hit by, a Lehman crisis, a Bernanke twist, Fed raising rates, or COVID. I don't care what the crisis is. I want access to that 24 months of money. So it gives me time to, turn my own sort of expenses around and manage my costs, etc., etc. And the rest of the money, so let's say if I've got 1 crore to invest, 24 lakhs is lying, in my case, in the quantum liquid fund, because to me, that's the safest asset class in India, because we invest in government bonds, not even in private sector bonds, no Tata, no HDFC, just only government bonds and semi-government bonds. And the rest of the money, the 76 lakhs, I started investing in gold long time ago and in equity. And within equity, again, I've got a very strong value bias. So I bought more of the value fund. And I cautioned investors, look, you guys should have a sprinkle of funds, not just the value fund. So there are multiple ways to achieve nirvana. You can be a Christian, you can follow Islam, Hinduism, Buddhism, whatever you want to call it. Ultimately, we all want nirvana. So I may follow this path of the value stuff. In quantum, to leapfrog a bit, we built something called quantum equity fund of funds. So we've got a value bias and we've got an ESG bias, and we built wonderful products for that. We don't understand small cap. We don't understand mid cap. We don't understand growth. Don't know how to make that work. No process has been approved by us internally to make us take that step for a growth fund or a small cap fund. But there are other fabulously smart managers out there working in other fund houses. Let's find the best. So of the 300-400 equity funds out there, we've selected 8 to 10 funds, which has got a sprinkling of these other asset managers. And I started writing in The Honest Truth that of that 80%, which is an equity of the balance after goes to liquid fund, you should keep a fraction of that in the value fund. Only 10% or 15% of that 80%. The rest of it, put it in the quantum equity fund of funds. And that people thought was crazy. Like, why is this guy launching a fund on quantum platform, telling us to go to other fund houses? And the answer was because we're trying to find a solution for you that makes sense for you, not something that necessarily maximizes our AUM by giving you product that we don't know how to manage and probably giving you a bad experience. So that again comes to that investor first attitude that I spoke about. So that's how the birth and the whole sort of genesis came of Bara B Sanasi into a product available on the internet. COVID taught us that people are now attuned to transacting on the internet big time, which is why you had the surge in SIPs, the surge in broking accounts, surge in folios, all of that came through COVID. You had no choice but to be technologically friendly and start using the internet to do transactions, which was a struggle before, in some sense. So that's kind of a brief history of how we jumped into, Bara B Sanasi.
Who is the Bara B Sanasi for? Is it for first-time investors? Is it for investors who fall into a particular age group, with specific risk appetite? Or is it for all?
The Bara B Sanasi is for anyone and everyone. You could be the Premji Foundation and you should be using Bara B Sanasi. And I'll tell you why. If you look at Harvard Endowment is $53 billion in size, right? They have an obligation to Harvard University to give them $5 billion every year. No, sorry, I apologize. To give them $3 billion every year out of the total expenses that Harvard has of 5 to 6 billion. Half comes from the earnings and the profits of the endowment. And if the endowment doesn't make money, like in say 2008, 2009, they have to still sign a check. So basically they have an obligation, and that obligation should be the liquid fund return, right? All the money I make from liquid funds should ensure that the large foundations have a steady stream of cash to fulfill their obligations. So that's for the rich people. For the person who's just starting, they may begin with a higher allocation to equity because they're 25 years old, they're 28 years old, they've got a relatively steady job, they don't really have many expenses, they may be sharing an apartment with their parents, staying with their parents, etc. They don't have that much cost to look after every month, but they are planning for the future. So they can not keep Bara, they can keep 3 months or 6 months in a liquid fund. And they can change the 80-20 to 90-10 to 95-5. It's such a flexible, powerful tool. It allows you to make your own portfolio suiting your own needs. And the best part is you can tweak it anytime you want to. Your situation changes, just go on the internet, log on to quantummutualfund.com, go onto your account, and you can change it to whatever you want to change it. Because I've done that. I mean, I've had changes in my life, and I've swept money from equity to liquid or gold to equity as the need arose. And it's seamless.
What you're essentially saying is that the 12-20-80 is a framework and that you can juggle and rebalance, as your life's situation keeps evolving. So, when do you see people from your vantage actually do that, changing or balancing their portfolios when things kind of change?
So we wish they do. I mean, people have got things that are static, and that's not good. Static is good for a while, but your life changes. I'm not suggesting you should look at your NAV in your portfolio every month, but certainly once a year, you should definitely be aware of what you own and what your goals are and whether things have changed so that it reaches from wherever it is into your pocket. But what's happened in India is that people have moved away from fixed asset investing, less into property, less into gold, or maybe enough in gold, but certainly less in property, and moving into financial assets. So when you don't buy a Mercedes car, it's actually that movement of physical assets has moved into, if you will, to financial assets. So it's not that the SIPs have grown. Yes, they have, but people have lost interest, and probably there's a generational change from what I hear from my adult children who say that, Dad, my son is 21 and doesn't really feel an urgency to get a driving license. I mean, when we were kids growing up, we couldn't wait to get a driving license to borrow someone's car and go on a spin. He says, no, Dad, I'll Uber, I'll Ola. So they don't really have a need for those kind of fixed assets, right? They are now buying experiences. He'll spend that money instead on going on a holiday, taking a selfie somewhere, drinking something, whatever it may be. Right, so that's the change. I think so. Mercedes has to fight that rather than worry about SIP payments. In fact, there'll be something else that's going to happen, and I'd love to talk to you more about this. In addition to systematic investment, we hope there'll be something, and again, Quantum was the first to do this, something called systematic giving plan, where you can actually take some of money, like Harvard Endowment, and allocate it to NGOs of your choice. We launched that in 2018-19. Along with Helper NGO and another company in the group, to select the NGO from there. But you can earmark some of money to give it away. So you invest for yourself, SIP, and you can take a portion of that, 1%, 2% of that, and give it to an SGP. So he's going to have a problem when people start giving monies to charity in a big way. And we know that Indian charity giving is going to explode over the next decade, not just from CSR from companies, but on another topic, also from retail investors.
Well, I think things are getting better. What is your advice to investors, in these times of rising interest rates, inflation and volatile markets, apart from, follow the 12-20-80 strategy?
Well, I wouldn't say apart. That's a very critical part, Melanie, of everything, because I really believe there will be a crisis again. We're seeing it. Interest rates in the world are rising. I'm right now in Europe, and I'm on my way to UK and then back again to India. And everyone in Europe is frightened about a bad winter, right? There's already backups. I met someone, met a potential client earlier this morning, and he was telling me that they're surprised to read in their local press here about how, if there's a bad winter, you may not get the full power you want. Tell your kids to play less video games, less streaming services. There's fear over here of a recession, of
an
energy-led crisis. Exactly. And a recession. And when that happens, it's going to hit India. Plus, what we're seeing in China, I don't think the press has taken it to the next level. If what we've seen in China is true, two things can happen. One is there's a regime change, which means turmoil. That's very unlikely. The second thing that's more likely is that China begins to open up on COVID. Now, opening up a society which has not been vaccinated to COVID, I read that a snippet somewhere, one line somewhere. There'll be an estimated 1.5 million deaths in China. Now, is China willing to open up and take 1.5 million deaths? Imagine what that does to supply chains. All the chips, all the stuff you need for cars or for computers, for laptops. So there's going to be a lot of supply chain disruption still in the world, in addition to high interest rates. So we're not saying that you'll get COVID, another virus, but there'll be hardship. And therefore, it's very important to recognize that 12, 20, 80 or 6, 10, 90, whatever you want it to be. You must be careful, must be cautious, but you must not forget that Indian stock markets are a fabulous place to create wealth. From 1980 till now, you could have compounded your wealth by 19% per annum by being an investor in a dumb index. And if you chose an active manager, possibly a good chance to make better returns. And we see for the next 10, 15, 20 years, you'll probably make 12 to 14% by being an investor in Indian stock markets. 12 to 14% is a wonderful number, even if you convert it for US-based investors or European-based investors into US dollars. On average, from 1966 till today, the Indian rupee has lost about 2.753% per annum. So from 12%, you take out 3% loss on the rupee, you can make a 9% gain on Indian investments in stock markets as a foreign investor, which is why we're very optimistic on India. We're optimistic on the future of the economy. We're optimistic on the future of stock market returns. But having said that, you have to be sensibly balanced across the three major asset classes of safety, what we call the quantum liquid fund, gold, which is the hedge against inflation and of a falling rupee. And the rupee will fall for a while. We're a growing economy. We need foreign capital. So we will have a declining rupee, as we have had the previous 5 decades. And third, the opportunity to create wealth by being by being an investor in the stock market.
Yeah, you've spoken about being a long-term investor and creating wealth, and the fact that, India is a fabulous destination for overseas investors or for Indian investors to create wealth. Ajit, this is my last question to you. For quantum, what are the strategies and areas of focus that you have identified going forward?
In terms of product,
in terms of product, yes.
So the only thing missing in our suite of limited products and relevant products, so we've given you Lego building blocks, right? You've got young children. They were young once upon a time. So they all had blue blocks and green blocks and yellow and red and purple and white. So we built all those blocks, and for you to assemble it the way you wish to assemble it. But there's one block missing. And that one block missing is exposure to international stock markets. So many other fund houses, rightfully so, have launched these fund of funds where you invest in a fund here and you get exposure to the NASDAQ or whatever. So we built and are awaiting, in fact, hopefully launched very soon, the last building block that's left is, well, I shouldn't say last, there'll be one more I'll talk about, is allowing local Indian investors to have a diversified portfolio of international asset classes. And that's that one building block that's left. The other one that's left to me is REITs, having a real estate exposure through a mutual fund. So SEBI came out with the REIT rules a few years ago. We spoke to them a lot, had a lot of dialogues with them. We thought they were not so good rules because the way REITs are today, existing real estate assets are being sold by developers or investors, large investors, onto platforms where the unit owners or mutual fund investors are buying. Our view is that no, just like how when you launch a new mutual fund, you don't own the shares, you have nothing. But you say, I'm going to invest in large cap or multi-cap or value stocks. You begin with cash, and then you're given by SEBI 3 months, 6 months time to actually convert that cash into the underlying investments. So our hope and expectation is that SEBI will allow what we will call blind pool, that you can raise the money and you're given 12 months to actually invest in the underlying real estate of your choice and then declare the NAV thereon. And if within 12 months, you're not able to do that, you return the money to the investor, but you as a fund house have to take a loss on all the costs to raise the money and to return it back to the investor. So the investor gets 100 back and you have a cost if you could not fulfill your obligation. That was our suggestion to SEBI 8 years ago, but they came out with a very different structure. So that's one thing missing, real estate.
All right. Ajit, we wish you all the success, to be able to put out the product that you hope will benefit the investor at the last mile and, make the system more transparent. Thank you so very much today for your thoughts and for your time.
Thank you, Maloney. We really appreciate it. I hope to see you soon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.